Good morning. It is Thursday morning. It's October 3rd, and we are on to the third day of trading in October as well as the fourth quarter of this year. And it looks like the morning is getting off on a low point. It looks like the futures are going to open a little lower. The NASDAQ futures are down about 0.5%. S&P's down, Dow is down. Crude oil is up. The tension in the Middle East is causing oil prices to go up to $72 per barrel. And that is good for oil stocks. I think if you own oil, you're seeing the hedge on other stocks play out. It tends to be that when oil prices go up, it tends to cause, or for some reason, most of the time, the rest of the stock market's selling off. So that's one of the nice things about having oil stocks. And we have been talking about oil stocks, geez, for about a month. It's been a good idea because if you bought oil stocks a month ago, you're sitting on a pretty nice gain. I know I've seen my Chevron stock go up. We talked about Oxy yesterday. We talked about Pump yesterday. And over the last 4 weeks, we've talked about a variety of oil stocks. So that certainly is working for investors. When we look at some other things going on, there is some economic news that's come out. And the economic news that is relevant to me is initial jobless claims. They came in a little higher than expected, but not too much higher. And if you look at the continuing jobless claims, they're actually coming in pretty much as they were before, just slightly down. And the forecast was a little higher. So that is interesting that continuing jobless claims are not a big problem. And the jobless claims over the 4-week average, again, not a big problem. This was my biggest worry a month ago. Was it seemed like the economy was beginning to go bad. And it seemed like we were beginning to see some job losses. Now, we've got a pretty significant strike on the East Coast of the United States as well as in the Gulf of Mexico that's going to stop a lot of the importing through those ports. I am sure that's going to cause a ripple, if not more, of an effect on the economy. So we will see how that plays out. We'll see how long the strike is. If it's a short strike, I think hopefully both sides walk away with something that's workable, acceptable for each other, and they just continue to operate the ports. The ports are really important to the United States because we import so many of the goods that we put on the shelves, especially as we approach the holidays, where a lot of people buy gifts and they buy things for loved ones, friends, and so forth. So let's see how that plays out. But I think that could affect jobs and it could affect the overall economy. I don't think it's going to cripple the overall economy, but it certainly can. If we're sitting here a month and a half later with a union strike ongoing, I think that's going to have a material effect on the economy because a lot of goods didn't make it to the shelves, and that would be a big problem. So unemployment's not becoming a big giant problem. We're going to have some other reports like factory orders and stuff. Those might be interesting for some. I don't pay attention to those. It's a decision where there's too much information that I can consume, and it just clutters my mind if I take in too much. I look at jobs, I look at GDP growth, I look at a couple of different metrics, and then I'm good to see what the economy is doing. So the stock market's opened. Now we don't have to deal with a futures number. Let's see if Google can give me an updated stock market number. So it looks like stock market's just getting out. Now this week has been somewhat of a slow week. I don't think there's been a lot of excitement in the U.S. stock market. I think some stocks have sold off, some stocks have rallied. It's kind of been a slow week, so to speak. There were some sell-offs that I expected because last month was so good that I bet a lot of big investors were selling some of their U.S. stocks to lock in those gains as they approach the end of the year. Totally understand. And it's good timing too. If you think about, if you sell some stock winners, you got a couple months maybe to pair it up with a loser and take that and harvest that tax loss. So that kind of makes sense from a timing perspective, that the market sold off a bit. Some people sitting on good gains. I took a gain on Starbucks, took a gain on Zim recently. So, I'm doing that as well. I'm sitting on gains, realized gains as we head toward the end of the year. I don't have a ton of like losses to harvest. So, oh well, I guess I'll have to scratch a check in the springtime to the government, which I will gladly do. All right. So, taking a look at the market, I wanted to look at how the sectors are doing. The VIX is up a bit. Let's take a look at the VIX chart just really quick, just to see how it's been doing currently compared to the rest of the year. Let's take a look. So we saw a giant spike, right? This spike came in August, but since then it hasn't been as dramatic, but we have seen a pretty good spike in volatility. Let's take a look at the monthly. Yeah, we saw the volatility really rise as we begin the month of October. All right, so I think there is some anxiety there. I continue to think we do have an expensive stock market. Doesn't mean it's super over expensive, but I think it is expensive. And, some of the data that I'm seeing kind of supports that story, supports that narrative that, hey, maybe stock prices are a little high. So volatility is entering the picture. Not too bad, but we can certainly see volatility spike. If like the tension in the Middle East were to escalate, I think that's kind of a game-changing moment, and the U.S. has to enter the picture. That's a game-changing moment. Other than that, I don't know of any other geopolitical thing that's going on. Of course, the election is here. Now, the election's going to happen in roughly 30 some odd days. I think we're down to like 32 days, 33 days, and then we're going to vote on a Tuesday in the month of November. And we will see who wins the election probably within 24 hours of the election happening. We'll know exactly who's going to be the president. We'll know what the Senate looks like, the Congress looks like, and then we'll kind of let it sink in and then move on. The market, I expect, leading up to that election might be selling off just because it's a little bit of overload. Like, oh my God, what's going to happen with the war? What's going to happen with the election? Hey, let me just kind of sit on the sidelines for 30 days and come back in mid-November. Once I know who won the election, what kind of trades are going to work, what do I want to do at the end of the year? We'll see. We'll definitely let time tell us what's going to happen. All right. So I wanted to look at sectors. And now that we have a market that's opened, let me hit refresh and then take a look at. So energy is leading the pack. Technology is right behind it. And then financials is holding its own. Materials have been interesting. I've seen a lot of chatter around material stocks, copper, and others. And some material stocks are beginning to work. There's a material stock out there that I wanted to look at this morning. I noted it, and I'll show it to you in a little bit. Communication services is doing okay. It's down 14.14%. Consumer staples is doing the worst, which is interesting. I guess that employment report came in and it was positive for the economy, showing that, hey, we're not in a big giant recession. So consumer staples are probably not that desirable because they tend to have, over a long period of time, 10, 20 years, consumer staples tend to be lower performing than other sectors like technology, like consumer services, like healthcare, and others. So if you're not going into recession, consumer staples just are not really desirable. So I could totally understand that particular sector is selling off. We are going to look at, I think, one staple today. I wanted to look at Constellation Brands, which I think is a staple. We'll take a look at it a little later. Real estate's down a little bit. All right, no big deal. No big deal at all. All right, so let me take a peek at interest rates. Interest rates have been, for some consecutive days last week, they were moving, and let's see here. There we go. So they were moving up for like consecutive days last week. And this week they sold off, or I should say, yields went down. Now they're going up. So when yields go up, I tend to buy, especially I buy into a long-term ETF, long-term bonds, because I already have the next 5 years covered. So I'm looking at longer term. And I've been asked questions around bonds recently. And the thing I would share with you is that, every investor, we're in our own unique little situation, which is, this is what I'm going to do over the next 5 years financially. This is what I need over the next 5, 10 years financially. This is what I'm trying to accomplish over the next 5, 10 years, financially. And bonds, it's not like overly simple formula. It's about, okay, so what do you want out of bonds? Do you want a solid, reasonable return, lower return than stocks over, a 10-year horizon? But the good news about bonds is that they're not going to go down. If they go down, it's rare. And if they go down, they don't go down that much. If they go up, it's a reasonable, low appreciation rate. But you get paid that interest. You get paid that yield. And that's why big institutions buy bonds, is they want the consistency and they want the predictability. So if that's what you need from a part of your portfolio, let's say you're gonna need some life expense, right, over the next 4 or 5 years. That's a pretty good vehicle. If you're looking to retire, and you want to make sure your living expenses are handled. Like in my case, I'm practicing kind of just always having my 5 years of expenses covered in my income portfolio without ever touching one share of stock. And I have that handled. So bonds are a very good asset class to consider. Right now, rates are pretty good and they're going to go down. So it's not a bad time to shop around for bonds, but it's not a very simple way of thinking about bonds. I think you got to think about what they do, what they can do for you. What is the time horizon that you want this investment for? The older you get, the more bonds you should own. That's a rule of thumb that I think I'm going to agree with. Warren Buffett and Charlie Munger was the exception. He was 99 when he passed. Warren Buffett's in his 90s, but a lot of these super investors are really invested in stocks. But Warren Buffett, he said that if he should pass, in his will, he has an allocation of two things for his wife. Is part of what he leaves as an inheritance should be invested in the S&P, and part should be invested in T-bills, treasuries. And most of it is in treasuries, by the way. I think he went 70-30, 70% treasuries, 30% S&P. So it goes to show an older person would have more bonds because they want that predictability. They've already earned their wealth. They already got more money than they're going to spend in their lifetime. So they want to preserve it. Maybe start giving it to their loved ones and doing things for the people they care about. Of course, enjoying it as well. But I think Warren Buffett is a great example. I never see any pictures of Warren Buffett like on a yacht or doing like lavish things. I usually just see him having a lot of fun with a smile on his face, talking to other investors. It's like, man, that guy, like, he loves making money. He loves figuring things out. He loves figuring stocks out. And I think that's super cool, man. That is super cool. All right. So we got through yields. It looks like yields are up. So it's a pretty good day for me to buy some bonds. I'll probably continue to buy into that long-term bond. Taking a look at the market again. Looks like the NASDAQ is close to even, but the Dow is down considerably. Nike was down substantially yesterday. I bought more shares in Nike. Nike's a Dow component. It's interesting that is selling off. All right. Okay, let me check some comments here. Shadow Guy, thanks for joining. Looks like there might be some bargains in the stock market. I appreciate you joining. Thank you so much. Thanks for your support. Mike, thanks for joining. I really appreciate your comment. Really appreciate the comment on the video I created. I think it's an interesting time. I thought it was going to be like I was searching for what's the idea a month ago. Like stocks seem expensive. It feels like I'm really having to compromise some of my valuation methods and preferred ways of investing, which is in a way, I think I've got a good visual. This is my preferred way of investing is, you know, um, look at an investment that does have high intrinsic value operating up here. The market dislikes that stock, doesn't understand that stock, just prefers other stocks, and it sells off to a point where it has a substantial discount. And I buy it in this zone. And then when the market realizes, hey, that's a pretty good investment, it rises, in value. That's not rocket science. It's just, it takes patience. It takes diligence, some work, understanding how to value companies based on intrinsic value, and then waiting for that to happen. So I appreciate the comment on the China stocks. And the reason why I'm excited about China stocks is to make this type of strategy work, you need discounted stocks. And if the stock market is really expensive, the charts would be like, they're not really going into the buy zone. So it's hard to find more stocks. In fact, I've been selling a few stocks, as mentioned, and just making my portfolio a shorter list. And I'm really glad I did so. I ended up with a good cash pile. And then China got exciting. So when I look at Chinese stocks, they're most definitely in this buy zone. It's never been a fundamental story with China. I don't know that anybody would say, oh, yeah, China stocks don't have good fundamentals. No, they have great fundamentals. And I think what was keeping China stocks down for a long time was sentiment toward the China economy and China stocks. But I'm going to show a video later. This YouTuber created a video on China stocks. Exceptional. Just excellent video. I'm going to show it to you. I'll give you the YouTuber's name too. But he covered China stocks really well. And I'm going to show that in a little bit. All right, Trader Pratt, good morning. Hopefully you make a lot of money on your trades today. Thanks for tuning in. And Yogi, NVIDIA flew away. So let's take a look at NVIDIA real quick. Let's see here. So is NVIDIA rallying? So NVIDIA is up 3%. I think it was up 1 or 2% yesterday. So it's rallying today. I know that the CEO came out with some news around Blackwell. And I would say this, that it's going to be interesting to see how the introduction of Blackwell affects near-term revenues. And I think the CEO is marketing Blackwell so much that I'm willing to guess that near term, they're going to see a decrease, not a negative growth rate, but you're going to see this growth rate really go down in the quarterly. Because what you do when you announce a new product, you cannibalize the current product. People are like, well, instead of buying the current product, I'm going to wait for the new product that's coming out next year. So I'm not going to buy the current product. So it tends to lower your short-term sales revenue. If that happens, I think it'll test the confidence of investors in NVIDIA. We'll see. Right now, stock's working. But I would say that the louder CEO beats the drum, I believe that the numbers are going to be worse, because he wouldn't beat like if he saw that revenue is just going to keep screaming up, why even say anything? When you do your earnings, you're just going to impress the market and your stock's going to rally on its own. That's the best type of rally. So we'll see what happens. Right now, it's up nicely. Congratulations to NVIDIA stockholders, and we'll see where it goes. All right, so Shadow Guy, bond yields up again. So you're buying into TMF, VCLT. So TMF. So so yeah, this one, long-term treasuries, interesting. Then BCLT. And then this one might be the one that I'm invested in too. It's a little early where I'm at, so I'm not super clear-headed. But you can see that the price is coming down, which means I'm getting a more desirable price. And the dividend yield is 4.74. So that looks pretty good. I think I'll buy probably another $1,000. I like $1,000 amounts. So good stuff. Good luck with that. All right. So, Trader Prad, are you referring to the stock market when you say it's the best video game in the world? I imagine so. All right, cool. So, let's get into a couple of stocks. I wanted to go over the earnings calendar. We had a couple companies announce earnings. Yesterday, we had RPM, and I wanted to look at that company. It looks interesting. And we have Conagra, which is a food company. And then today we had, sorry, I'm jumping around here, Constellation Brands, which is a pretty well-known company that distributes beers and beverages and stuff like that. So let's take a look. So RPM it's a material company. We were talking about materials earlier, specialty chemicals. And RPM International manufactures and sells specialty chemicals for industrial, specialty, and consumer markets worldwide. It offers waterproofing coating and traditional roofing system sealants, air barriers, tapes, foams. So a lot of stuff around roofs. Now, you know what comes into my head when I read a company like this is we had a horrific hurricane hit some southern states. I think Florida, Georgia, Tennessee, even North Carolina was severely affected, and the the damage is severe, and the roofs have been really damaged. So I think there's going to be some demand for materials that are going to repair those roofs. So that's a thought that came into my mind: is these guys may see demand because there was so much damage due to that weather. All right, so this company is a $16 billion company, revenue 7.29. PE's a little high for this type of company. 26 a little high, 22 there. For forward PE, it is a hold and it's priced fairly according to analysts. When I look at their financials, revenue is pretty flat. I think I think construction hasn't been great, but in years past, it was really good. You can see 2021, 2022, 2023. You know, people were putting money into their homes because they were, in many cases, they were working from home. They didn't have a lot of things to do, right? They weren't traveling because the social distancing rules and all that good stuff. So they put money into their houses. So they probably pulled in a lot of demand from future years into 21, 22, 23. So now they're dealing with, hey, you know, we're not growing like we'd like to be. In fact, the latest quarter, they're down about 2%. So, okay, well, they're going to have a little bit of a downturn, but let the economy kind of begin to have demand for their type of products. So, not a big red flag there, just an observation. I think it's normal for this cyclical business to have a slowdown. That's normal. Balance sheet wise, they have $231 million of cash, and hopefully they don't have a ton of debt. They have 2.36 billion of debt. So when I look at the cash and the debt, they're about 2.1 billion in net debt. Looking at their EBITDA, they do about 1 billion in EBITDA. So in about 2 years, they'd pay their debt off. So a good balance sheet. They're solid balance sheet. Not a lot of problems there. So I'm glad to see that. Now, when we look at the free cash flow, that's my desired way of valuing companies. And they've been a cash producing company. They had a really nice year in 24, fiscal year 24. Looks like they have a a different fiscal year than the calendar year, but they're up to 800. So 800, it's really not growing. It's not one of my favorite sectors and industries. It's an okay industry. They're kind of at a low point. I'm going to be curious to see their stock chart and see if the stock sold off and see if this one is fitting uh, this type of situation. Has it dropped in value because it's going through a cyclical part of its industry? So I'm going to say that this stock, multiply it times 15 versus 10 or 20, 10 being no growth. I don't foresee it growing. 20 being pretty good growth. And then if it's a high growth company, I might multiply times 30 or 40 if it's super high growth. But I'm going to go with 15, which get me to about $12 billion of market cap. And these guys are priced at 16. So this is not a stock for me. There's just not a lot of excitement in the stock. I don't expect that over 5 years, this one's going to double for me. I think part of it is that it's already been appreciated quite well. It probably the investors looked at the numbers that they were producing in 21, 22, and 23 and thought, man, this is a really good company. So they bought up the shares. Great. Good for them. And they brought the stock back up. But I would guess and estimate that they're not going to do this again for 5 years. Just the cash flow is not there. This is not an overly profitable industry. I need to see a little bit better of a discount. It'd be nice to see something like this, right? Where the stock has sold off temporarily because they're going through a cyclical downturn, but it hasn't been the case. Maybe it will be the case in the future and it might become a good investing idea, but for now it's not. So I'm going to pass. Looking at a company that's more of a staple, super staple, food, Conagra. Conagra does food, and they do consumer packaged goods. You find them in the store when you buy, food at the store. They have a variety of brands that you would buy. It's a $14 billion company, almost $12 billion in revenue. And you see their forward PE is really attractive at 11.45. That looks interesting and a pretty decent dividend there too. We look at their 5-year, it really sold off. Wow, maybe this one's a pretty neat little idea. Let's take a look. It's really sold off. It sold off beginning in April, and it's kind of stayed down. Interesting. Okay. It's down today as well. And it just announced their earnings and announced them yesterday. So there's fresh data that we're going to look at. So the annual, you see that their revenues come down. Now, this is food, right? The food industry is not like super high growth. It's going to be slow growth. But in 2020, you saw that inflation just really hit the consumer. And it kind of makes sense because people had a run on grocery stores. They didn't go to restaurants because we couldn't go to restaurants. So they went to Costco and grocery store like Kroger's. Everywhere you can buy groceries, people really changed their habits overnight. So they really grew in 2020, kept that growth going. And for a food company to grow at these levels, that's very good. So now inflation's down. So I think these numbers where you see negative growth, that's because of inflation. It's not because they're a terrible company or customers aren't buying their product. It's because, like eggs is an example. I think at the height of the inflation curve, eggs were like $8 a dozen or something. That's for a dozen eggs. That's almost, 80 cents an egg. And that's really high. They should be about $2, and maybe $3. My mom's a super shopper and she goes to this one grocery store. I drive her there and she gets them for like $1.80 or something, and it's great. It's great to see her operate. So eggs are really expensive. Food is really expensive. So that was the case years ago, but now inflation's down. Consumer wins, but Conagra's kind of taking a haircut on the revenue. Their gross profit is decent. You can see that their gross profit's still there. You see that their gross profit has been expanding. So that's good. So they've become more efficient and their inputs are probably less expensive as well. They're going to put it on the shelf at a lower price, but the farmers that are selling them the ingredients that go into that food product is also less expensive. So at the end, they're still profitable. Very good job, Conagra. All right, so I'm comfortable with their revenue. I understand the situation. I'm okay with the situation. Now, when we look at their balance sheet, they've got 128 million in cash. Total debt's 8.7 billion, so pretty much 8.6 billion in debt. Can they afford that debt? EBITDA is 2.2. So they're writing about debt that would take them 4 to 4.5 years to pay off. That is a red flag for me. It's like, why are you carrying so much debt? Now they're probably, so that's a little too much debt, frankly. They can't grow their way out of debt, right? It's a food company. Let's see if debt's been increasing. Yeah, it increased big time. Wait, I'm looking at the wrong line. Sorry. Total debt. So no, debt's been declining. It was worse. It was like 10 billion and it's been declining, which is good. Let's take a look at their cash flow. So cash flow. So free cash flow looks good. So that balance sheet's kind of a little scary, but they do have good cash coming in so that they could use to pay off that debt. It'd be nice to see them get that to that three times EBITDA on the debt level, because I think they are a riskier stock because of that. If they were to have a couple of things go wrong and they couldn't make that debt payment, it'd be pretty tough for them. Again, they're in an industry where, it's been around for thousands of years, right? People growing food, and then we sell the food. People buy the food, consume the food. So these guys are in that very mature industry. I'm a little surprised they have that much debt, but they do. That's kind of a red flag. I'll see. My best estimate is if the balance sheet was the only red flag and I valued this company, I'd probably multiply it times 10. And I'd probably get to like 15 billion of value. And they're about a $14 billion company. So I think it'd be a decent investment if somebody was looking for a good dividend stock. This is a stock that has been sold off. It probably isn't going to sell off much more because it is a well-known company. It's an established company. It does carry a little extra debt, and you can look at a dividend yield of 4.74. I'm pretty sure they could afford that dividend. They had pretty good cash flow. So their payout ratio is actually really high for the quarter. But that's kind of surprising that ratio came out that way. I would have thought that it would have been lower because they do have good cash flow. So this one's a pass for me. I'm not looking for okay stocks. I'd rather keep my money in bonds. If I want an okay return, bonds is pretty much guaranteed. Okay, you're going to have an okay return and you're not going to have volatility. Well, with Conagra, it could drop another 20%, and there goes all the dividends for 3-4 years. So it's not worth it to pick up a stock that has the downside risk. So yeah, well, wish Conagra the best. We'll see if that stock gets better maybe in a year's time. Moving on to Constellation Brands. These guys are a beverage company, consumer staple. These guys produces, imports, markets, sells beer, wine, spirits in the United States. Their biggest brand's probably that Corona brand. It's pretty popular. Now it's a $46.5 billion company. Revenue is $10 billion. Okay. Their PE is okay. It's a strong buy with a 14% discount. When we look at the stock is down. When did it announce? It announced earnings this morning. So this is a reaction to the earnings. And looks like earnings have been updated for the quarter. The quarter did grow. It grew 3%. They grew last quarter. Growth looks pretty good. Wonder what investors dislike. So the growth looks okay. Cost of revenue. Their gross profit has been expanding. You see how it's expanding? And as I look at stocks, I think you guys hear me say this is consistent data that shows an upward growth rate is the best data that a company can provide. Now, they can't manufacture it. This reveals the performance of the company, how good their products are being sold, how profitable they are, and so forth. But when you show gross profit expanding like this, a little bit, but upward, a lot of confidence. I'm confident in their business. They keep growing it. Customers like their product. They keep getting more customers. And they're operating quite well. Their execution in making the product, distributing the product is efficient. So that's a very good sign. That's a green flag. I've been using the red flag analogy. So good growth, good profit. So let's make sure they don't have a bunch of debt and have a bunch of problems. So cash, very low cash balance of $64 million. And their total debt's $11.5 billion. Okay. So when we compare that to their EBITDA, $11.5 billion of debt, but EBITDA is 3.84. So they can pay debt off in less than 3 years. So if you multiplied this times 3, you'd get to like 11.8 or close to 12. So that's more than their current net debt. So, all right, balance sheet is okay. Let's take a look at their cash flows. If I valued the company using cash flows, what would the company be? And I'm going to use just a quick factor to see if it's worth my investigation. So good cash flow. Again, back to the data set, right? Positive free cash flow, positive free cash flow. This is a cash flow generating company. I guess their valuation at around 46 billion. This is why is investors look at these numbers and they're confident that they're going to keep producing 1.6 billion in revenue. It's a growing company, 1.6 billion. This company is worth probably about 35 to 40 billion dollars. I multiply 16 times 20, I get 32. There's probably a premium because it's a good brand, so I'd maybe go up to 35. But they have that debt, right? I always decrement debt from their overall valuation because I think debt should reduce the overall value of a company. So this one's worth about 32 to 35 billion in my mind, and it's way above that. So I'm a pass on this one. You can see the 5-year rate of return is 20%. That's not all that great. So this one's an investment for somebody else. It's a consumer staple. And that's what I mentioned early in the stream, that consumer staples aren't working. They work when everything else is destined to have a terrible year. Investors might go to, the consumer staple, sector, but we also have access to bonds. I prefer bonds because they're more predictable. If I just want to, put money in an investment that's going to be more steady and give me a lower long-term return, but it's more consistent, more predictable, I'll go to bonds. I don't need to expose that capital to a stock that could lose 10, 20% in a year and then really spoil the return overall. So interesting company. Looks like they announced the market didn't love the report and it's selling off. So good luck to Constellation Brands. All right, so let's take a look at the stock market. The Dow is still in the red. S&P is close to flat, and NASDAQ is at 0.43. This Russell, smaller companies, really selling off. Okay, interesting. All right. So let me go over Chinese stocks. Now, Chinese stocks I think they're selling off today. Let's refresh this guy. Yeah. So you're seeing a sell-off in Chinese stocks. So I'm going to buy into this sell-off, and I'm currently an investor in Alibaba. I'll probably buy shares. I just started buying NetEase. I'll buy shares. And I started buying into Baidu. I'm going to buy shares. And then I own an ETF that is pretty much Chinese stocks. I'm going to buy into that ETF. Now, the pullback, it looked worse in the pre-market trading. looks like these stocks are recovering. So I'll probably be done with my stream and I'll probably transact my trades. But I wanted to show you a video. This is Momentum Investor, and this video is excellent. One of the best videos I've seen in, I don't know, a couple months. And I'm kind of skipping to what I thought would be a nice clip for us to watch. And I think he did, the whole video is awesome. But let me play this clip and then I'll come back and comment.
Catch that last part? He's talking about if some
Hopefully my internet cooperates here. Come on, internet.
Chinese stocks, in particular internet stocks like Alibaba, managed to retrace back to their all-time highs, that would be a huge risk to reward trade. Think about it this way. You've got a 50% stop loss if you put it below the all-time low or local low here. And then you've got about a 200% gain all the way up to the all-time high. Now that is a 1-to-6 risk to reward ratio. I'm not saying that it's going to be a successful trade, but it sure does look pretty appealing to me from an investor's point of view. Which brings me to my final segment, and that is my favorite Chinese stocks right now. And of course, my first pick is Alibaba. Why? It makes up a large portion of China ETFs like the MCHI and KWEB, and if the PBOC does buy equities, it'll probably buy ETFs that hold mega caps like Alibaba, which in turn means that the central bank and other institutional investors will be plowing billions of dollars into Alibaba in the next 12 months. Another reason is that Alibaba, like many other Chinese stocks, have formed a technical bottom. I've been bullish on Alibaba since May, if you look at some of my past videos, and I believe that this round of stimulus measures is just icing on the cake. And this breakout recently is basically just confirmation. Another Chinese stock I like is Xiaomi. It's one of the biggest smartphone brands in the world and is growing revenue every year by taking market share from the big dogs like Apple. And it's also printing money hand over fist, as you can see by the cash the company has been accumulating over the past few years. And just like Alibaba, Xiaomi is starting to buy back its own stock, which is always a bullish sign. Also, the chart is looking very strong with a definitive breakout on high volume. It also started rallying before this round of stimulus, which leads me to believe that it already had strong tailwinds for valuation expansion, and this is just more fuel for the fire. My final stock is Zijin Mining. I'm a copper bull, and I believe this copper gold miner is one of the best mining stocks in the world. It has some world-class mine and is managed really well, which has set the company up to reap the benefits of the coming rally in copper prices. That's right, I believe the rally in copper is currently reigniting, and this is just the beginning.
All right, so again, this video is one of the best that I've seen in the last couple months. I'm only showing you a clip. The rest of that video is solid, like just great analysis, great insight. He's covered China for a while. So we're dealing with an investor that really knows his stuff. And as I move on to look at two stocks that he brought up that I had no idea who they were, I wanted to just, share with you an observation that we are in the golden age of investing. We just saw an investor that is not a big channel investor. He doesn't have a big, giant, company that's telling him you got to talk about this and don't talk bad about that. So he has no agenda other than just sharing his analysis. And that's awesome. And we have a lot of access to good information to make good investments. So I think it's an awesome time to be an investor so that you can collect good information and make great investments and make a lot of money and accumulate great wealth. So let's take a look at two stocks he brought up. First one was Xiaomi, and I'm probably pronouncing it wrong, so I apologize, but and I think it's Xiaomi. And this one here, so it's over the counter. I don't like over the counter stocks, but might have to just deal with it, I guess. And he said this was a hardware, software, mainland China, Internet of Things, internet services, and other segments. So let's take a look at their website just so I can get a visual on what their company is about. and I can do that through the profile. They're headquartered in the Cayman Islands, and they do that because the Cayman Islands offers really desirable tax treatment. And all right, so these guys are doing this type of product. Okay. All right, so they're doing wearables, smartphone, lifestyle, air compressors. Okay. All right, so we got to handle. I thought it was going to be more like smartphones and stuff. Really high market cap, 77 billion, revenue of 42 billion. They don't. It looks like they're not profitable yet. This is in USD. These numbers are in Chinese yuan, or yuan, excuse me. They have been growing the trailing 12 months. Growth is really good. Now, when I go 88 billion yuan times 0.4, I think that's going to be around 12 billion in revenue. So that's about a $12 billion company. Their profit is decent, but not really high. You can see that it's only, these guys don't give me a percentage, but their gross profit is like 20%. It's not great. I think Conagra was better, a food company. All right, so high growth, but not great profit. Okay. Balance sheet, they have, call it close to 14 billion in US cash. This is almost 100 billion in yuan. And debt. So they have more cash than debt. Way more cash than debt. They have roughly about 5.5 billion in US debt, and they have close to 14 billion in US cash. So they have, let's call it 8 billion in cash. So they can do whatever they want with it after they pay off the debt. That's pretty good. That's pretty good. Cash flow wise, have they been cash flowing well? And this is over the counter, so we're not going to get beautiful statements, I don't imagine, but let's take a look. So free cash flow. So remember that the comment I was making is I like consistent cash flow. Like just show me that you're around a number and you've been increasing it over time. These guys cannot do that. They're going from, this is all yuan, but 20 to 18, down to 2, down to negative 10, 35, 20. It's like, what's the next number going to be? 20? That'd be kind of a guess. It's not, you know, I don't feel as confident as other companies that we're looking at. So this one here, I mean, I think we were showing the market cap in dollars. So I'm going to try to do it in dollars. So I'm going to make it life easy on me and say it's about a $3 billion free cash flow generating company. They are a growth company. I don't like their gross margin, but I'm still going to give them a 20 times 3 billion gives me about 6 billion in value. And for some reason, you know, investors love this company and it's way higher than that. I'm thinking to myself, so in the 1 year, it's up 100%. Over the 5 year, it's up 165%. So these have really taken off. And this one, I'm curious to see, why am I so far different? Let me double check my cash flow. This is in yuan. Okay. And remember, I saw that they're not very profitable. They don't create a lot of profit. We're going to look at Apple next, and you'll see what profitability should look like if you want to be a tech super company. So their operating cash flow, and you see how it's up and down. It's kind of all over the place. But this in yuan converts to about 3.3 billion, maybe 3.4 billion. Okay. And do they have a lot of CapEx? Not too much. Okay, good. Free cash flow. Yeah, I mean, it's about 3 billion. Okay, I'm sorry. did the math incorrectly. So if it's about 3 billion in free cash flow, if I multiplied it times 20, I'd get to $60 billion valuation. Okay, that's where I went wrong. And 60 billion versus 77. Right now, I'm seeing other Chinese stocks that are just looking fantastic from a valuation perspective and a fundamental perspective. This one's not looking fantastic. I think part of it is it's already up 100%. And I mean, if we would have started a year ago, maybe it would have looked fantastic at that point. But the fantastic phase is over. But it's cool to see another investor online. He sees a company that he really likes, and from a momentum perspective, I mean, look at this stock. Last month, it's up 20%, which isn't keeping up with other stocks that have been just crushing. 48% year to date, but this is a winner all day long. So interesting stock that investor pointed out. Let's take a look at the other company he brought up, which was a copper miner in China. Now that one does catch my attention because I'm liking the material companies, buying them early before the stock market realizes, holy smokes, copper is going to be super valuable. So this is this company here. The 1 year, it's up 47%. The 1 month, it's up 16%. But it has had kind of a pretty good pullback here that began in May and it hit the very bottom September. So recently it hit kind of a bottom. This is a pretty big cap company, 67 billion, and then 40 billion revenue. Okay. Small dividend, and they're not profitable. Okay. So when we look at their revenue, looking at the annual, they have been growing. See the growth here. That was phenomenal. Wow. The economy in China did slow down, but the economy is expected to really pick up, and they're going to need copper. They're going to need copper for a variety of reasons. So I expect this growth rate is going to accelerate. When we look at the quarterly, it is pretty flat, right? But I'm expecting they're going to have a tailwind of growth. Maybe the pullback that we saw in their stock when it sold off was because the revenue isn't growing. So investors are like, hey, what's going on? Let's see how profitable this company is. So gross profit, you see that 53 from 30, that's about 16, 17% margin, gross margin. So that's not great, but it's a miner. So that's just the way it is. Very expensive to buy the equipment, hire people. The extraction process is expensive. A lot of fuel into the machines you have to use, all kinds of stuff go into that production or that operation. Okay, so I'm not in love with their gross profit, but let's keep going. When we look at balance sheet, let's take a look at their balance sheet. So the cash and short term, this is all yuan. So this guy is going to be about 5 billion in US dollars. And their total debt is 146, and that's 14, call it 20 billion. So when we look at, 20 billion minus 5 billion is going to be 15 billion net debt on their balance sheet. And I wonder if this is in US dollars. Yeah, US dollars. Okay. So 6.57. So yeah, they're less than 3 years debt to EBITDA, because if you multiply 16.57 times 3, you get to about 20, and they have net debt of 15. So balance sheet looks okay. Let's see what kind of cash flow they produce. Some of these miners produce great free cash flow because a lot of their costs are sunk costs, and it's in the form of depreciation, which is a non-cash item. Now we're going to look at, see this CapEx. Ooh, that's a big number. That is anti-free cash flow because you take operating cash flow minus CapEx, and that's what gives us free cash flow. Free cash flow is not all that impressive. And you can see here, negative, a little bit, a lot, less than a lot, double a lot. So it's been growing. That's good. It's been growing nicely. Looks like they have their operation down. They're really extracting a lot of copper, selling it. And if the commodity price increases, they're going to be making a lot more free cash flow. So at 11.3 billion, if I put that in US dollar terms, we're dealing with about a 1.6 billion free cash flow number. They are growing. I go 15 because this industry I don't put a big value on. But if I did that, I value the company at around $20 billion. And they're way above that. I don't quite understand how this company could be valued that much. And it's a little bit out of my zone, right? Like I can buy TX, I can buy BHP, I can buy what's that British company? Rio Bravo or Rio something, not Rio Bravo. It's let me try to find it for you. Rio Tinto. So this is it's headquartered in the UK. Of course, their mines are all over the world. But these guys, you can value this company at their current market cap. And so there's other options. And those options to me are more familiar, easier for me to understand. So I'm a pass on those two ideas. But it's nice to take a look at something that is maybe off the beaten path in China that another YouTuber, thought was interesting. So, all right. So stock market, what's going on stock market? Okay, now we're all down. What the heck? Dow is down, S&P's down, NASDAQ's down. So it's kind of a lazy week, man. Not a lot of big action, just kind of slowness. Looks like Shadow Guy. It's not sold in the US yet. Yeah, it's not traded on the New York Stock Exchange. You'd have to do an over-the-counter trade. And I don't like those because it's kind of more red tape and cost on the front end. And when you think about when you're going to sell that stock, you're going to see that type of resistance when you try to find a buyer of your shares. So I don't really like over-the-counter shares. That's somebody else's investment. So it'd be nice for them to get put on the New York Stock Exchange. It'd make it easier for investors like me. All right, so we covered a little China. We covered the economy. Let me look at sectors real quick and see what's going on with the sectors. So technology is number one, energy, utilities, industrials. Well, the three sectors that are in the green, utilities, energy, technology. All right. My current phone is actually, so they make phones, smartphones. Oh, interesting. Cool. So that Xiaomi company is known in Portugal, according to Sergio, and it is it's well known. That's cool. I think that's one of the headwinds that our friends at Apple have is they have a phone that's being other producers are producing phones that are competitive to it. Maybe not as nice. The brand has a lot of prestige around it. I get that. But you're paying a high PE. It's a massive market cap. They already have a growth problem. 2023, they had declining sales, and trailing 12 months, it's flat. Okay, so it's flat because companies like Xiaomi, Samsung, Huawei, they're putting their units out there, and the consumer's sitting there going, iPhone cost me $1,000. This other phone cost me $100. I'll buy the $100 phone, especially if you're buying it for a son or daughter. I can speak from experience. I had to replace a number of phones. So you don't want to buy the most expensive phone. You want to give your kid, a phone that, if they lose it, okay, it's not the end of the world. Let's go buy you another $100 phone. That's why I would at times buy used phones. But oh well, raising kids is expensive, but it's being super meaningful. And I love my boys. Wouldn't see myself without them. So that's where I'm at with that. Okay. Wow. So this is an interesting comment. So there was a year when Xiaomi sold more phones than Apple and Samsung. That's interesting. Wow. All right. So Apple is down a little bit. Okay. All right. So I think the market is going to be another kind of uneventful day other than Chinese stocks selling off. So I think to me, that poses a opportunity to buy into that space. I have cash to work with. The valuations look good to me. So I am buying into China. Where's my China stocks list? Here it is. And man, they're coming back. Oh, I've been on this live stream too long. I got to boogie and go buy some shares, man. I hate to see them go green before I buy some. So everybody have an awesome day. I appreciate you joining. Let me just put one more plug out there. We have a paid member program, really trying to grow it so we can have a community of, just members that come together for a conference call. First one's this Sunday. If you become a paid member, you'll be invited. If you become a paid member at $10 before the 6th, which I believe the 6th is Saturday or Sunday, you're going to be upgraded for the life of your membership to the next rung. But after the 6th, everybody will have to pay the level that they're going to subscribe to. So if you want to be part of the member call, you have to be in the second rung. But if you sign up today, you'll automatically be there for $10 versus $25 a month. You'll get access to the tools. Again, that's a $25 membership value. If you sign up today for $10, you get that. The link that I was providing before, and I apologize, several of you were trying to get signed up, wasn't working right. And I apologize. It was a mistake that I made and I corrected it. The new link that I'm providing in the description of this stream should work. I tested it this morning and it should work. So if you can, take a look at it. If you can afford it, awesome. Be a member. I hope the current members, I really appreciate you. And I hope that you're getting a lot of value. I want to create more value for this channel. I'm having a lot of fun with it. I'm making a lot of money on my portfolio. And there's a lot of lessons that I've learned that I would love for you guys to benefit from it. And I want to benefit from your experiences. I just saw another YouTuber cover China. I get a ton of value from that. I've been doing this for 10 years, watching YouTube videos, investing in companies that make sense to me. And it's the golden age of investing. I think we can all become better every month and become better at making money on stocks long-term. My approach is to make money over the long haul, consistently, year after year, and have fun at it. I have a lot of fun owning some of these companies that I own. I'm having a lot of fun looking at China, trying to figure out which one's going to be that really cool China trade. And as the community has gotten bigger, it's been awesome to see all the collaboration, but I'm going to have to limit my collaboration to probably a subset of the community. And it'll be that paid portion of the community so I can really lock in and be of assistance to the people that I engage with, as opposed to trying to answer messages to 1,000 people. I just can't do that. I'd probably do a very bad job at it, but I could probably handle, a couple dozen people communicating with me, and we can collaborate and help each other become better investors. So I encourage you to do that. And I want to wish you guys the best success in investing. Let me play a little music as we head out of here. Enjoy your Thursday. I like Thursdays because we're that much closer to the weekend. Welcome to the live stream. Let's see what the market's doing today. See if there's any opportunity really enjoy. Everybody have an awesome Tuesday. Thursday. Look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable, all produce high free cash. That's why I'm looking for high free cash. All the best investors depended on free cash and evaluating the company's ability to generate cash flow. A company company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks have taken the show, but our mid cap stocks going to come back. Going to come back. Chinese stocks are exploding. The dragon has awakened in China. It could be the best trade we've seen in a while. Really interesting. AI is going to be interesting in the future. But is it really a business today? I'm going to pass on this stock. Just not enough discount. And I'm not really believing that they're going to grow as they should. Options can make your performance go a little higher every month. Generate nice. Listen to the great super investors. They are pretty generous with their knowledge and their wisdom. You just got to read their books and listen to their video. Learn something new every month. In investing, you'll become a great investor. You'll build wealth. This is a buy stock. You're looking at a discounted stock. It's unappreciated. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. Bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor, and you will build great wealth.